Every now and again, a series of price action presents itself that, whilst it might not fit within our normal mode of trading, does provide us with an opportunity to build a strategic framework that we can apply to instruments that we do trade in the precise way that we actually trade. And such a situation has arisen with Mineral Resources, an ASX-listed stock. What has prompted me to have a look at this stock and see what ideas we can build from this was this headline here. This headline comes from the Australian Financial Review, and it outlines the actions of hedge funds as short sellers of MinRes. The rationale apparently for this short selling is not necessarily the price action of MinRes, but rather the collapse in the lithium price, the withdrawal of their largest customer, China, and the difficulties it is facing, and apparently an appalling balance sheet. Whilst I was aware of MinRes, because of its price, it doesn't fit within my ASX trading universe. In terms of looking at short selling, for those who are unfamiliar with the notion of short selling, it is simply the process of selling a share you do not own with the perception of buying it back later on at a lower price. So the idea is quite simple. Functionally, it involves a little bit of paperwork behind the scenes, but that is the basis of it. By and large, in many respects, it is the preserve of larger investors and funds such as hedge funds, simply because they can better deal with the paperwork and back office requirements of this process. It is also because they can generate very large position sizes that actually make it worthwhile without using derivatives. I should declare at present, a little caveat of my own, I don't short sell ASX equities. Whenever I've included it in my systems, it actually degrades the performance of the system. Part of the reason for that, and part of my reluctance for short selling equities, is that they're simply bounded. In an ideal universe, the most you could ever make from a short sale is 100%, but that would not happen because to short sell a share, it has to be on a prescribed short sale list or have stock that can be short sold. If ever you had a situation where a stock was collapsing at such a rate, it would be removed from the short sale list and your positions would be terminated. When you buy equities, you can buy an equity at 10 cents and with good grace and a lot of luck, sell it 2 years later at $5. So you get that massive, almost unbounded gain. That doesn't occur with short selling. Doesn't mean it is not a valuable tactic. I use it all the time in the trading of commodities. When looking at short selling, I first went to this very clever little site called shortman.com.au, which looks at the short sale figures on ASX-listed stocks. And as we can see here, we can see a dramatic rise in short sale exposure in MinRes over the past few months. Whilst having a look around this particular site, which is well worth going to have a visit to, I had a look at their top 10, and this is just an aside. And you will see a lot of these in their top 20, are mining stocks, which tells you something about the current state of mining stocks in Australia. It doesn't tell you anything about their future state, and that's something to be aware of. One of the additional caveats I will put on this is that people think that such figures are in some way predictive. They're not. They're reflective of a position and an opinion that other people have. Once again, my opinion, your opinion, or their opinion might not match with the market's opinion, and that's where we have to be careful. If I look at the current top 5, I can see this reflection of heavy short selling within the Australian mining sector and the rise of MinRes as a stock being short sold. In terms of getting some idea of where we are, this is just looking at the drawdown in MinRes, and as you can see, we have a current drawdown of just under 54%. Stock hit a high of 96. It's now sitting, when I snip this, at 41.29. So it has taken a battering, and it took a battering in 2 phases. And we can see the phrases of price action here. We see the lithium boom, sideways movement, carry on from that sideways movement, stock then begins to degrade, small period of recovery, then large collapse. This is the current state of play with, I would advise you to be careful of that last candle simply because of the way Metastock assembles its data. It's not fully formed yet, so don't completely trust it. Look at your own weekly charts at the end of the week. If I begin to apply some sort of analysis to this, I've just applied a simple breakout system to this, volume down the bottom. We can see the signals being given from 95 as the stock collapsed down. There is a small recovery as the stock bounces from this 55.60 mark. Few long signals in there. Stock then gives up and comes down under relatively heavy selling. We do have that reversal candle. Selling again, another reversal candle, but again, be wary of that. If I am to look at this from a strictly trading and not a position building exercise, this is a daily chart of Mint, and to it I've applied my daily trading system. The thing I want you to note is the ribbon along the bottom. The ribbon along the bottom is a background filter. It tells me about the state of the background trend. So it's an attempt to filter out noise and get a sense of what the prevailing sentiment is. You will note there's three colours: green good, red bad if you're long, and grey. Grey indicates a period of transition. It indicates that sentiment is now churning and is not defined. So we can see, if we read along the bottom of the ribbon from the very start, we have bulls in charge, ill-defined, bulls in charge, ill-defined, long period of bulls in charge, ill-defined, long period of bears in charge and collapse, now ill-defined. Where sentiment is churning, there is this argument about who is in charge. So we need to be aware that sentiment changes. The other thing to be aware of is that with short selling, the concern with short selling, particularly when large bodies are short selling, and there are lots of them, you will get a situation where everybody wants to run for the same door at the same time, and not everybody will get through. This is known as a squeeze. Short sellers are very aware of their potential to be squeezed, and a squeeze simply means that you have a period of transition from bears being in charge, market's a little bit sloppy, bulls are now in charge. Short sellers will have a pain point at which they must exit. To exit, they need to close the position out. Closing the position out will cause the price to spike. Spiking the price will make the squeeze worse, which will force more people out, which will force the price higher. So they're intimately aware of this. So you need to be aware of sudden spikes in price and volume as everybody races for the door. So this is part one of our strategic look. It is this notion that we look for these changes in sentiment, one of which is occurring at present. A change in sentiment in and of itself is irrelevant if not followed through with definitive price action. Market could continue to slop for days or weeks on end, and this would enable the short sellers to gracefully exit their positions. If I were looking at this from a simply technical perspective, not waiting for my system to kick in because the system has lag. It's based on historical data, so it will always have lag. You'll notice along the bottom that the background filter has changed a little bit. This is because this is a short-term trading filter. You'll notice instead of being indecisive, it's now flipped to green. So the background filter is telling me something. What I need now is some form of trigger. And you'll see that I've highlighted this particular gap. As I've mentioned before, gaps that occur in concert with the prevailing trend and an increase in volume are a very powerful signal. The reverse is true. A gap that is filled under volume is also a powerful signal. So in a hypothetical world, the second part of my strategic look at this would be finding a reason to go. For me, the reason to go would be my background filter has changed. I've got a series of green candles and I have this gap. And if this gap is filled, that's a signal for me to take action. I'm going to do something I don't normally do, and that is flip down to a lower time frame. I don't normally do this because the moment you lower a time frame, people's thinking tends to become a little bit squirrely. This is a 4-hour chart of Mint. I don't trade equities on a 4-hourly basis. I trade other instruments on a 4-hourly basis where liquidity allows. But this gives us a wonderfully precise view of where that gap is and the attempts to pierce that gap. So once again, we come back to this notion that we need a trigger or a pivot point. So we understand the background strategy of what is occurring. We also need to understand that when short sellers move, they will move very, very quickly. And because their positions are so large, we've seen with Min, it's 11% of the capital. It's a very large position. They will have to compete with one another. The thing that drives price up, people often say it's more buyers than sellers. That in part is true. But the thing that really drives price up is competition among those particular buyers, because the only mechanism we have of competition is price. If I wish to buy, let's say $41, I have to compete with everyone else. And if I'm to displace them in the queue, I have to bid higher than they do. This sets off the cascade. So this brings us to, I think, what is the global point of this video. And this is this notion that strategy beats tactics. Whenever you come across a situation like this, and let's say it presents itself like this, you need a strategic approach. You can't make these things up as you go along, because that's a recipe for disaster. In many ways, this is somewhat akin to what? There's a perennial statement where people talk about warfare. And the statement is that amateurs talk tactics, professionals talk logistics. It's the how and why, not necessarily the doing. Because at the end of the day, unfortunately, any idiot can buy a stock, but it takes a professional to know why they're buying the stock, what has triggered them in, and more importantly, what will trigger them out of that particular position.
Don't forget to like the video and subscribe to our channel.